investment strategy requires that we have a clear understanding of what it is we're trying to achieve. So in financial literacy terms, we need to have a financial plan. We need to know what our goals are and when we want to attain them, so that we've got some milestones there in front of us. Some targets, tangible, time-bound targets. Then we can think about, well, how do we invest? How do we save to attain those targets, those goals, such as the new car, the deposit for the house, the retirement further away. And we also need to think about, well, what risks are we prepared to take to get there? So we need to know about our appetite for risk, our risk profile. And a financial planner can assist us in drafting such a document, or we can prepare it ourselves. But once we know what we're after, then we need an investment strategy to get us there. And part of that is going to be buying various financial instruments, shares, bonds, savings account deposits, etc., in order to attain those goals. We need to create a portfolio of investments which has a risk level that we feel comfortable with, so we've done our risk profile, and yields a return that will get us to where we want to be. So a portfolio is a collection of various financial investments, and like the proverb says, don't put all your eggs in one basket. By diversifying, by putting a number of securities into the portfolio, we reduce the risk of something going wrong. Now, we have created this portfolio and we need to think about, well, how are we going to manage this? Is it going to be an actively managed portfolio, one where we're adjusting it all the time, paying the transactions costs to trade in and out of various securities in order to attain that risk return profile that we're after? Or are we going to be more passive about it, occasionally reweight the investments in the portfolio, but mostly leave it alone and take a slightly longer term view that it will return a good return commensurate with the risk we are bearing? So you can invest in an active managed portfolio, or you can invest in a passive portfolio. There are other things to think about too, whether you want property in the portfolio, whether you want growth shares or value shares and so on. And this all requires us to have some knowledge of the terminology. Like a bull market is when the stock market's going up. A bear market is when the market's in decline. A stag is somebody who buys shares when they're first issued in the hope that when they are listed on the stock exchange they will sell at a higher price and a nice little capital gain will be made. So we need to understand some of the terminology. We need to be financially literate. How does one acquire this sort of knowledge? Well, the most obvious way is to talk to a financial planner or talk to a full service broker, pick up some information, learn how it works, and as you develop your own skills and competencies in this area, then you can reduce costs and trade online, make your own decisions. But tread warily initially, learn, gather information, and as I say, the NZX in New Zealand or in any other country, the stock exchange homepage normally has some very useful guides for investors. Become financially literate before you embark on investing.